Hello and welcome to another CMS Forex Daily Market Recap. I'm your market analyst, Nassar. Today is Thursday, November 5th, 2009. We start today's recap with a look at the Bank of England interest rate decision, where policymakers held the rates at 0.50%, though they did expand their asset purchase program by another £25 billion to £200 billion overall, though that amount was smaller than forecast. The committee also sees the prospect for a slow recovery as they see financial institutions having to still restructure their balance sheets and are concerned about what happens once loose monetary policy and government stimulus measures start to decrease. A second report from the UK showed that manufacturing production for the month of September grew 1.7%, a figure that was better than expected and is a strong rebound following a 2% decrease the previous month in August. On the year, output is down 9.3%, an improvement from the 11.3% decline in August and slightly better than forecast. Industrial production was up 1.6%, also a figure better than expected. If we take a look at the pound-dollar pair, we see a rather strong surge following the Bank of England announcement, as expectations had been for perhaps a 50 billion or even a 75 billion expansion of the quantitative easing program. Once we reached our high around 1.6635, however, the pound wasn't able to sustain those gains and fell in the subsequent hours down to the 1.6550 level, and then around the close of the global session we were trading just below 1.66. The 1.66 level has been an important level of resistance for the latter part of two weeks, and though we did puncture above it, we fell back below in later near trading. The last three sessions have shown a pound rally in this pair, and it'll be interesting to see if we see further move up in tomorrow's trading, though traders now await the nonfarm payroll report from the US. This slide overnight in the pair came as Asian stocks were lower, and if we plot a little Fibonacci retracement, we see that the correction was about 61.8% of this rally yesterday from low to high. Now, despite the pound gaining in the wake of today's release, the gains by the pound might not last, as in this environment right now, the Bank of England is one of the few banks that is increasing its loose monetary policy, while others are either holding firm or, like in the case of the Reserve Bank of Australia, are beginning to tighten. So this move could imply some weakness in the pound in the more medium term. The European Central Bank, meanwhile, held their rate steady at 1%, and for the most part it was not much in the way of surprises, though in his conference following the decision, ECB President Trichet did say that the bank was getting ready to phase out their extraordinary liquidity measures, though they would do so in a timely and gradual fashion. The euro-dollar pair, after sliding overnight to 1.4810, stayed within a pretty narrow range in today's trading, peaking above 1.49 briefly in the wake of US morning data, which we'll get to later. And it seems that traders really are cautious right now in the wake of, as they await the October jobs data from the US. The last 2 or 3 sessions have widened this sideways channel that we have been seeing, so we can probably move our resistance and support levels a little bit and adjust them. And if we take a look at our move from 1.5050 down to our low for the week around 1.4630, we see that currently we are testing the areas around 1.6018. So we've retraced about 2/3 of this down move through late October and the beginning of November. And a look at the euro-pound pair, we see some support established here, and today's trading, though it created some volatility, stayed within the range we've seen this week. Against the yen, the euro, which had slid overnight, managed to pair its earlier losses and was trading slightly above where it started the session. That means that it was able to hold on to its gains from yesterday's trading, where we did see a rather strong rally. Overall, the fact that the ECB seems ready to begin ending its extra stimulative measures means that the euro could be stronger in the medium term, all things being held equal. Also overnight from the Eurozone, we saw retail sales data for September, which came in better than expected, with sales climbing 0.7% for the month. That followed a 0.2% decrease in August, and when forecast had called for 0.3%. Turning to the US, we saw a positive report from the labor market, where jobless claims for the week ending October 30th fell by 20,000 to 512,000, a figure that was the best since January. Continuing claims also fell for another week to 5.74 million for the week ending October 23rd. As we saw with the euro-yen pair, the dollar-yen pair also was able to recover its losses from overnight, rallying to about 90.70 in late New York trading. That moved us above the 90.60 level, which was a level of resistance in earlier New York trading, and is a line that we could see here was acting as support in yesterday's session. Still, today's trading remains within the range we have seen recently, and as traders remain relatively cautious this week. In our look at our last fundamental release, we see that in New Zealand, employment change for the third quarter fell 0.8%, a figure that was worse than expected, and follows a 0.4% decline in the second quarter. Also, the unemployment rate jumped to 6.5% from 6%. So that was a very weak report coming from that economy. Now look at the New Zealand dollar US dollar pair. We do see a slide overnight following that poor employment data, which broke a short-term level of support here and fell to the 71.60 area where it found support. If we zoom this pair out a little bit further, we see that we're in a bit of a consolidation pattern here with converging lines of resistance and support. Again, like most of the pairs we've seen, we're sticking within the ranges for this week. It seems likely now that traders will await tomorrow's non-farm payroll report in order to find new direction in the currency markets, though it would probably take a figure that was either highly above forecast or highly below forecast to really move the market. Despite the three major economies here, the US, UK, and the Eurozone all having their interest rate meetings, the global monetary policy landscape is still pretty much where we started at the beginning of this week, and until we see a dramatic shift there, we might see currency starting to break free of their established ranges. So let's take a look at what data we have coming up tomorrow. Tonight, from Australia, we get the RBA quarterly statement along with a measure of construction activity. Overnight, Japan posts its leading indicators, Switzerland unveils its unemployment rate, the UK posts its producer price index, and Germany will release its factory order. Tomorrow, as I've mentioned, we get the US non-farm employment change, which is expected to show a decline of 180,000 jobs lost in the economy, which should be an improvement from September, though there are indications that the number could be more bearish than that. The reason for that is a weak employment index within the ISM services index that we saw earlier in the week. We also are going to get employment data from Canada, and the US in the will also post its wholesale inventories and US consumer credit in the afternoon. And that'll wrap up this market recap. Thank you very much for joining us here at fxtimes.com, and happy trading.